Welcome to Agricultural Science for SS1 at Light Tech Academy. Today we study agricultural finance and credit. What is agricultural finance? Agricultural finance is the management of money and financial resources in farming. It covers raising capital, money, to fund agricultural activities, managing income and expenditure, and evaluating whether farming enterprises are profitable. Without finance, farmers cannot buy seeds, fertilizers, pesticides, equipment, or hire labor. What is agricultural credit? Agricultural credit is a loan or advance given to farmers to finance farm activities, to be repaid with interest at a later date. Credit is essential because farming has a long production cycle. Farmers spend money at planting time but receive income only at harvest, months later. Without credit, poor farmers cannot afford inputs. Types of agricultural credit. By duration, time period. 1. Short-term credit, repayable within 1 year. Used to purchase seasonal inputs, seeds, fertilizers, chemicals, casual labor for one crop cycle. Source: banks, cooperatives, money lenders, government intervention programs. 2. Medium-term credit, repayable in 1 to 5 years. Used for farm equipment, plows, tractors, processing equipment, and livestock, buying breeding stock. Source: agricultural development banks. 3. Long-term credit, repayable over more than 5 years. Used for land acquisition, irrigation infrastructure, land development, and large capital investments. Source: mortgage institutions, government development finance. By source. 1. Formal credit sources. Commercial banks provide agricultural loans, often at high interest rates, 20 to 30% per annum in Nigeria. Require collateral, land title, assets. Most Nigerian smallholder farmers cannot access formal bank credit because they lack collateral and land titles. Bank of Agriculture, BOA, formerly NECO, Specialized Agricultural Development Bank established by the federal government. Gives credit to farmers, cooperatives, and agricultural businesses at lower interest rates. Central Bank of Nigeria, CBN, intervention programs, Anchor Borrowers Program, ABP, short-term credit to smallholder farmers. Commercial Agriculture Credit Scheme, CACS, large-scale farmers. Agricultural Credit Guarantee Scheme, ACGS, CBN guarantees bank loans to agriculture so banks face less risk. Microfinance banks provide small loans to low-income farmers. Less collateral required. State government agricultural funds. Various states have revolving funds or subsidized credit schemes. 2. Informal credit sources. Money lenders, available but very high interest rates, 50 to 200% per annum. Exploitative. Farmers fall into debt traps. Rotating savings and credit associations, ROSCAs, Isusu, AJO, Adashi group members pool savings and each member takes a turn receiving the lump sum, rotating credit. Common in Nigeria. No formal interest. Builds capital for farming. Commodity merchants/input dealers give seeds or fertilizers on credit, input credit, to be paid after harvest. Often at inflated prices, implicit high interest. Family and friends, informal, often interest-free. Cooperatives, members save together and lend to each other at lower interest. Financial institutions in agricultural finance. 1. Bank of Agriculture, BOA agricultural specific loans. Lower interest rates. 2. Nigeria Incentive-Based Risk-Sharing System for Agricultural Lending, NERDC, a blended finance institution, CBN subsidiary, that shares risk with commercial banks to make them more willing to lend to agriculture. Provides credit risk guarantees and technical assistance. 3. Agricultural Credit Guarantee Scheme Fund, ACGSF, established 1977. Guarantees bank loans to agriculture up to 75% of the loan amount, reduces bank risk. 4. Central Bank of Nigeria, CBN, various agricultural intervention programs. 5. State microfinance banks. Farm records and accounts. Farmers who keep records of income, expenditure, and stock can assess profitability of different enterprises. Apply for formal credit. Records show creditworthiness. Make better management decisions. Common farm records, farm diary, daily activities. Cash book, daily income and expenditure. Stock records, inputs on hand. Production records, yield per crop. Labor records, workers and wages. Farm budgeting. A farm budget is a financial plan that estimates expected income and expenditure for a season or year. Types: enterprise budget, for a single crop or livestock enterprise. Whole farm budget, for the entire farm. Partial budget, for a proposed change, e.g. adding a new crop or switching to a new variety. Gross margin analysis. Gross margin equals gross income, variable cost. Variable costs, also called direct costs, are costs that vary with the scale of production, seeds, fertilizers, chemicals, hired labor. If gross margin is positive, the enterprise covers variable cost and contributes to fixed cost, land, depreciation. If gross margin is negative, the enterprise is unprofitable at that scale. Challenges of agricultural finance in Nigeria. 1. Lack of collateral. Most smallholder farmers do not have land titles, customary land tenure, to offer as collateral. 2. High interest rates. Commercial bank rates of 20 to 30% per annum are too high for farming. Typical farm profit margin is less. 3. High risk. Nigerian agriculture is heavily rain-fed. Climate risk, pest risk, market price risk make banks reluctant to lend. 4. Poor loan repayment. Default rates are high, partly due to crop failure, partly due to deliberate default. 5. Poor record keeping. Most farmers cannot demonstrate creditworthiness. 6. Limited reach of formal banks. Commercial banks are concentrated in urban areas, poor rural access. Remember, agricultural finance equals management of money and financial resources in farming. Agricultural credit equals loan or advance given to farmers equals repaid with interest later, essential because farming has long production cycle, spend at planting plus receive at harvest. Types by duration: short term, within 1 year equals seasonal inputs, seeds plus fertilizers plus chemicals plus casual labor. Medium term, 1 to 5 years equals farm equipment plus breeding livestock. Long term, more than 5 years equals land acquisition plus irrigation infrastructure. Sources: formal, commercial banks, require collateral plus high interest 20-30% per plus most smallholders cannot access, plus Bank of Agriculture, BOA equals specialized agricultural bank plus lower interest, plus CBN intervention programs, Anchor Borrowers Program plus CACS plus ACGS, plus microfinance banks plus state agricultural funds. Informal money lenders, very high interest 50-200% plus exploitative, plus RUSCO/ESUSU/AGO/ADASHI, rotating savings and credit associations equals group pool savings equals each member takes turn equals no formal interest equals common in Nigeria, plus commodity merchants/input dealers, input credit equals inflated prices, plus family and friends plus cooperatives. Key institutions: Bank of Agriculture, BOA, plus NASO, risk sharing equals CBN subsidiary equals guarantees to commercial banks, plus ACGSF, guarantees bank loans up to 75% equals established 1977, plus CBN. Farm records, farm diary plus cash book plus stock records plus production records plus labor records equals essential for creditworthiness plus profitability assessment. Farm budgeting, enterprise budget plus whole farm budget plus partial budget. Gross margin equals gross income minus variable cost, seeds plus fertilizers plus chemicals plus hired labor. Positive equals covers variable cost plus contributes to fixed cost, negative equals unprofitable. Challenges: lack of collateral, no land titles equals customary tenure, plus high interest rates plus high risk plus poor loan repayment plus poor record keeping plus limited rural reach of formal banks. Thank you and keep excelling at LightTech Academy, powered by LightTech Solutions Limited.